Welcome back. You're watching Stock Watch with me, Zinatu Guma, and joining me to take your stock-related questions tonight are Alex Duys from Umthombo Wealth and Jean Pierre Verster from Protea Capital Management. Be sure to send your questions to stockwatch@bdtv.co.za or via SMS to 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. It seems that the markets are calm ahead of the elections tomorrow. Alex, I want to start off with you. Is this the calm before the storm, or just that markets have settled into a certain narrative ahead of the elections?
Evening. Now, look, the markets, in a way, has already priced in, I guess, the election to some extent. We have seen the markets having a reasonable last couple of months, and so specifically some of the ink stocks like the banks picked up from their lows a little bit and so forth. But yeah, we'll see more movement depending on the outcome that's happening tomorrow. So yeah, I think also yesterday was very low volumes, right? With the holidays we saw. Volume's not great at the moment. I think there's still a bit of a wait and see approach, specifically from foreigners. But as I mentioned, some of it's already been priced in to an extent. Unless there's any shocks or surprises that we're going to see tomorrow or over to come.
It's going to be very interesting to see the developments over the next few days. JP, is there a certain way that you have been positioning yourself ahead of the elections or not? Because, for example, we have seen a lot of optimism going into SA Inc. stocks, I think, over the past month. It wasn't a sell in May and go away kind of scenario.
Yes, ours was like a sell in February and go away situation. So I was nervous February because there was some uncertainty about the election. So we decreased our exposures in February. And since then, we've slowly but surely increased our exposures again. We brought some rands back from overseas. And now that the rand has strengthened, we'll wait a little bit, but maybe in 2 weeks' time, it might be an opportunity to take rands back offshore in the next week or two. We'll see. So in general, also a wait and see approach. But when we have the elections and they're behind us, and hopefully a week from now we hear that the outcome is not too unexpected, I think that could be good for South African equities. And that's why after selling and decreasing exposure in February, more recently, our net and gross exposures have increased again to South African stocks because they still remain very cheap. Yes, growth is low, but with just a little bit of growth, we can ignite some positive movements on the JSE, I believe.
Yeah. Alex, have you also joined the choir in terms of increasing your exposure to SA Inc. stocks since they're cheap? And it looks like markets are pricing in a scenario of policy certainty after this election.
Like, you also have to look at valuations relative from emerging markets to developed world. And emerging markets in general looks very attractive, specifically relative to the US. And then if you look at South African valuations, it doesn't matter if you look at an absolute relative basis or relative to its own history, it does look cheap as well. But as Jean Pierre referred to, obviously the growth is a problem as well as the risks in the country. So that to some extent is discounted in share prices. Now, what is usually quite a powerful force when it comes to markets is when rubbish becomes less rubbish. So in the case of South Africa, everyone is pretty much written us off. So if there's any sort of positive movements, let's say, for example, Eskom is starting to do relatively better. Infrastructure investing is picking up. GDP goes from 1 to 1.5 to the snowball effect starts picking up and foreigners starts buying in. Grey listing is removed. And so you can see quite a material rally in our market. So yes, small changes can make a big impact. I do think at the moment, Africa, from a risk-adjusted perspective, looks to be quite attractive, quite interesting, specifically compared to some other developed market countries where the valuations are a little bit too full for my liking.
All right. Well, talking about low valuations, of course, we have seen the healthcare stocks not being loved too much. Netcare, Life Healthcare, though we did see a little bit of a bounce on Life Healthcare when it released results last week. Discovery also being a victim of the selling off because of the NHI. There's a question here. Am I wrong for seeing NHI as an opportunity for private hospitals? Won't they be making money by having controlled increase in patients? Jean Pierre, any insight on that?
Yes, I think the logic is sound, and that is that if we do get a successful implementation of NHI, and that's a big if, it's also a big when. So if and when, then I think it's potentially very negative for the medical aids and medical aid administration businesses, but it could be quite good for the hospitals. It would increase their paid patient days, which is effectively the occupancy rate, because you'll have the whole population that could theoretically go to private hospitals and probably would prefer to go to private hospitals because they are better equipped, better resourced. And if those paid patient days or occupancies can go from 60, 70% to 80 to 90%, that will fall down to the bottom line of the hospital groups very nicely because they are high fixed cost businesses. So yes, there's still a lot of water that must run underneath the bridge before we do see NHI, if it ever will be implemented. But if it is, the private hospital groups should be beneficiaries thereof.
Yeah, and I really hear your point over there. And of course, I guess the long-term impact of NHI is for kind of phasing out of medical aid. Alex, Discovery, I know how hard it was hit when the NHI bill got signed into law. Do you think that the markets have fully priced in the, I guess, final impact of that? Or maybe not? As JP said, it's a big if and when.
Look, I mean, Discovery, I have shared my views on the stock before. I'm very negative towards the business. And that was even before the NHI situation. So Discovery got a lot of problems, in my opinion. But let's focus just now on NHI. So the administration business of Discovery is pretty much the cash cow for the business. So that's the, I would say, the good asset. Yes, it's ex-growth, but it generates a vast majority of cash flow in the business. And that's where the business has really come from. So if there's an impact on that business, as Jean Pierre alluded to, with NHI, the political healthcare bill will be under pressure. Then Discovery will be under severe pressure in such a scenario. They will be by far the one who will probably be the most negative affected in that regard. So yes, I would say that's a negative. But just on the NHI and hospitals, I think one thing I also have to remember, even if everything is done perfectly well, the implementation is good, the funding is there, we still remember we've still got a lack of supply of doctors and nurses. And most specialists already are working 6 days a week, 12 hours a day. They don't have the capacity to work more, right? Specifically at the lower price, which they will get paid if it's an HI. So obviously these doctors will then also rather go overseas where they can charge rate what they want to charge, or we have to train a lot more doctors, which we're not doing. So there's a lot of other issues as well in there. It's not about simply just giving the funding and so forth. We have to look at the actual human capital that's also involved in this NHI.
Yeah, so assuming that a lot of things do need to come together, and you're right, that shortage of staff, employees, doctors and nurses is actually something to be very concerned about, something that particularly Netcare has been crying about for years. JP, just on Discovery, because it's quite interesting that Alex says, he's not really a bull of Discovery since even before the NHI. The actual business, I don't know, I feel like it may kind of be polarizing a little bit. Where are you on that fence?
Yes, Discovery is quite a polarizing stock, a polarizing business, because it has got quite significant complexity. And it's a bunch of different businesses in the same group. You have the medical aid administration business, that one is relatively simple. You have the life insurance business, which is probably the most complex. You have short-term insurance. You have some offshore operations within these different lines of business in the UK and investments in China, the internationalization of Vitality as well, where they're trying to hitch that to, say, some American health groups. And then the bank, which in the early days is also very capital hungry. So an interesting one, and you saw already with the implementation of IFRS 17, the new accounting standard on insurance contracts, what the significant impact was on Discovery. And a lot of people say, oh, but the future cash flows don't change. Well, the one thing that has changed is the profit recognition of the past. And what the adjustment showed is in the past, Discovery recognized too many profits. And it was just another little red light to make one aware. So on that polarization spectrum, I'm probably also a little bit more on the negative side than the positive side.
All right. I hear you. There also Pick n Pay. One of the stocks that also I think is very polarizing, because you have a lot of people saying it's cheap, and Pick n Pay is not just all of a sudden gonna fail, but then there are others that are saying that there's still so many risks. And of course, even though you do have this strategic plan that Sean Summers came out with in January, there's also execution risk, although he is saying that there are green shoots that they are seeing. And it was quite interesting to see the share price movement as well, because after the results got released, the share price was in the red. And then as we went through the day, it surged to about, I think, 5%. Alex, with Pick n Pay, what's your take there, and particularly on its investability at this point?
It's a difficult one. I mean, for Pick n Pay, the three things against them is obviously the weak economy, time, and the weak balance sheet. So the question is, can it actually execute within those parameters, efficiently enough in order to get the turnaround that they need? Now, listening to what they're planning to do, it does make, for me, in a way, strategically sense. But the question is, will they be able to have enough time to do so, and will the economy allow them? So inflation is coming down, so that's going to put pressure once again on the top line. And we're already seeing, of course, all the investments they have to do, closing of stores and so forth. So that the focus is not really going to be on sales and marketing. So I think revenue is going to be a bit of a challenge. While still got some input cost, inflation or cash drain. So all of these factors makes it very, very difficult. But if they can execute, for example, get the core Pick n Pay business back to, call it, break even, there's no doubt there's some substantial upside, in my opinion, in the overall basket. Assuming that Boxer does get listed at some of the valuation multiples that's been shown in from the analysts and so forth. So I would say cautiously optimistic, but like I've alluded to, those three things that still makes me concerned. It's time, balance sheet, and execution to the economy.
Yeah. JP, your take on Pick n Pay?
I would say I'm cautiously pessimistic. Pick n Pay is almost like a Rorschach test at the moment, where you see an image and the one person can see something good and the other person can see something bad. And maybe it's my nature, but I'm a bit skeptical. They're going to raise 10 to 12 billion rand. That's a 4 billion rights issue and another 6 to 8 to list a minority stake of Boxer.
Yeah.
That is an enormous amount of money. The business currently is technically insolvent. It's got negative equity. So there's a big hole to be filled. And then the big thing where the positive values come from is when you strip out Boxer and you say Boxer's making between 1 and 1.5 billion rand of profit. You put that on a 15 to 20 PE, and you say the rest is maybe worth zero, and that's when you get the big numbers. And I question that type of calculation that a lot of the sell-side brokers are doing, especially because it's going to be 3 years before the group is profitable again, according to their own targets. They're going to be cash flow negative, up to 1 billion rand of negative cash flow for the next year, potentially still negative the year thereafter. And whenever you do a segmental analysis on a company, and you've got one very profitable division, I always wonder about the cost allocation. So I wonder if Boxer, when it becomes a standalone business and it's separately listed, is going to be as profitable as they show in these pro forma numbers in the presentation, because they haven't quite finalized the transfer pricing, where Boxer might make use of the head office of Pick n Pay. So there's a lot to be done here, and like I say, I'm cautiously pessimistic.
All right. Well, a company that had profits reduced is Pepkor. Retailer Pepkor, of course, the consumer environment remains tough, but at the same time, it was quite surprising to look at the different divisions, seeing that fintech division doing pretty well from a retailer. And Alex, what are you making of Pepkor right now, and just how they're positioning themselves in the market?
Yeah, Pepkor, a few shows back, it was actually my stock pick for the first time in many, many years that I've actually think Pepkor was looking quite interesting. So yes, obviously in South Africa, Ackermans and Pepkor, Pep itself is not really growing that fast at the moment due to the weak economy, but still very, very strong businesses. Ackermans is slowly but surely clawing back some of the mistakes they've made in the recent past. And if there's any uptick in economic activity, you should see them doing quite well. And then you've got a Avenida business, which in Brasilia. This business continues to surprise so far. I think if they can perhaps perform for another 2 to 3 sets of results, the market probably going to give a high valuation or more attention to that particular asset. And then obviously the fintech business, where it does feel like this business is moving a lot more away from general retail to more into fintech, credit sales and so forth. But that does give it quite a nice driver, I would say, for them going forward. So yeah, I think you can do a hell of a lot of wisdom buying Pepkor at the moment in South Africa. So for me, it looks reasonably interesting at these levels.
Yeah, everybody, it seems, is moving to fintech. Pepkor, JP, would you be putting any optimism behind this stock or not?
I broadly agree with Alex on this one. I think Pepkor is one of those businesses that is potentially at an inflection point. And if we do get a little bit of an uptick in growth in this economy, and they get, say, double-digit revenue growth, you'll see very nice operating leverage to the bottom line. So it's sort of, just waiting for any growth, profits roughly flat. And if we do get that little bit of growth above expectations, I think also Pepkor can do quite well. So I'm in the same camp as Alex on this one.
All right. JP, I want to stick with you because we spoke about this briefly during the break. Accelerate Property Fund. How does the panel feel about Accelerate Property Fund now that Investec has taken an 8% stake in the REIT? And you're saying that's not really the case, JP?
Yes, they didn't really take a stake. They were sort of given a stake. What seems to have happened is the director, or the company owned by the director, had a loan with Investec, and he gave some Accelerate shares as security for the loan, and he defaulted on the loan. So Investec took his shares. So Investec now has 8% of Accelerate. I'm pretty sure they would prefer not to have 8% of Accelerate and rather have their loan repaid.
Yeah.
But now they've got the shares, and 8% is not so easy to sell in the market in a small, relatively illiquid share. So it's going to be interesting to see if Investec is going to get a little bit more activist here. Are they going to find a block buyer that's quite brave and wants to effectively buy into the Four Ways Mall that is not well designed and is not attracting enough footfall? That's the major headache in the portfolio. So it's going to be an interesting one. It's not the first bank that is ended up with some shares it does not want. And normally what happens is the banks either find a block buyer if they're lucky, or they need to get a bit activist and make some changes if they have a significant stake. So I think there's a few more chapters to be written in this interesting saga.
Yeah, sometimes you see a car that you wouldn't really buy with your own money, but you're like, well, if somebody buys it for me, sure. Alex, Accelerate, would this be one that you would be buying physically with intention or not?
Coco, what JB has said there. Accelerate Property does have let's call it an interesting history. And they've obviously now in recent history also been forced to sell a lot of assets to try to get the leverage down. I think there's a lot of better opportunities in the South African market for viewers to consider. Let's see how this thing pan out. But it's not a company that I look at actively to buy.
All right. Well, a company whose momentum seems to be going up is Rainet. They came out with results today. Quite interesting also the dividends that they got from their interests there. We did see optimism in the share price climbing more than 4%. JP, is this one that you'd be putting your money behind or going the other way?
It's one I like, not love, but like.
Okay.
If you look at their long-term track record, they've grown their net asset value per share at roughly 8% per annum in euro terms. That's very solid. And then with the depreciating rand, you get a boost if you look at the rand growth. Even in this period, at the end of the announcement, they give you the rand HEPS which is very nice and kind of them, given the high number of South African investors. And I think it was just over 20% growth in HEPS because the rand is also weakened against the euro. A nice collection of assets. Still have a lot of British American tobacco. Pension Corp is the big asset, but is doing very nicely, doing a lot of big deals in the European pension market, the UK market rather, of defined benefit plans that a lot of big companies want to sell to people with big balance sheets like Pension Corp. So that's working well. And then a bunch of, call it, investment funds that they've invested in, including the old Lehman Brothers private equity business and a few others in Asia and across the world. So a nice collection of assets that Johan Rupert has been managing well. He earned a very nice performance fee, 90 million euros in this year, after a few years of not earning a performance fee. But the performance is there. So you probably can't be too cross paying a performance fee if you got 8% in euros over the long term. So I like it, yes.
Of course. And really that even the momentum of the share price has actually been looking good, particularly over the last year. Alex, what do you make of Rainet and the numbers that they put out today?
Yeah, I concur with JP there. I mean, so at the moment, the stock is about 30% discount to NAV, which I think is pretty much fair for a business. Due to the fee structure that JP has referred to. So Pension Corp is, I think, about 52% of the business now. And I really do like the prospects there. I mean, at the moment, there is a huge market in the UK for defined benefit pension plans. And most likely can also look to expand that in other countries over time. But at the moment, they are leading market share there. They're doing quite well there. So I think that asset for me is quite interesting for South African investors to access. And perhaps over time, there could be some value unlock opportunity as well in there. They can perhaps look to unbundle that or get rid of that. There's some corporate action to look out for longer term. And in the meantime, Pension Corp is also paying out dividends. They're going to pay out the second dividend now, and that's going to flow through to Rainet shareholders as well. So yes, I do think it looks quite interesting, and we like it at these levels.
All right. Well, some other stocks that you find interesting. Let's go into your stock picks, gents. JP, what is your stock pick for today?
So we just spoke about the investment holding company trading at a 30% discount to NAV. My stock pick is similar. It's the investment holding company HCI, Oscan Consolidated Investments. It came out with results last week, as well as a bunch of its underlying companies in which it has material stakes. Most of them are listed. The likes of Sorgo Gaming, Southern Sun Hotels, you have Frontier Transport, you have Deneb and eMedia, a few of the smaller players. And if you put all the listed assets together and you add in some unlisted assets, and especially Impact Oil and Gas, which is the big unlisted asset, then I think you get a sum of the parts of 250 Rand a share, trading at 175, so that's a 30% discount. But the key for me here is what will that net asset value per share do for the next few years? And I do believe it'll grow at an above average rate, driven by Impact Oil and Gas as they start developing those gas fields, the Venus gas field principally in Namibia. We might get a bit of a bonus with some of the gas fields on the southern coast of South Africa also being developed in the next few years. And then the other assets I like as well. I mean, Sorgo Gaming, it's throwing off a lot of cash. Southern Sun with its Western Cape hotel footprint is well positioned. Occupancy is rising. So if you can buy all those nice assets at a 30% discount and you think it's going to grow at a nice rate from one year to the next, why not? So that's my stock pick tonight, HCI.
All right. Alex, what are you buying?
So my stock pick tonight is a famous brand. I think obviously the consumer's under pressure, the business not doing well. And you see it in the latest set of results. I mean, the business didn't really perform at expectations. But I'll take a bit of a medium-term view, yeah. I think patience is required with famous brands, but I still believe they can grow their revenue in real terms. And they most likely will be some margin expansion as well. I mean, the margins in all the divisions, franchise, manufacturing, logistics, is below optimal margins. And at the same time, they're looking to reduce finance costs as well. So I think if you take a medium-term view, it's quite likely if they can grow their revenue at low double digits, high single digits, they can easily grow earnings low double digits, compounded over the medium term, in my view. And that makes it quite interesting at these levels. But you need economic activity to pick up, and perhaps if there's a positive election outcome and people are looking for SA Inc. stocks, famous brands could be a beneficiary of that. And you also need a lot of buying because liquidity is quite poor in the stock. So one or two asset managers buys into famous brands, it could move the needle quite a lot. So yes, I think it's time to look at that one at this stage.
All right. Well, thank you so much for your time and for your analysis today, gents. Happy voting for tomorrow. That is all for tonight's Stock Watch. Thanks to our guests, Alex Duys from Umthombo Wealth and Jean Pierre Verster from Protea Capital Management. Up next, the close. Stay with us.